If we had to summarize all of our 2025 themes into one, it would be finding the appropriate price to pay for an investment. From an economic standpoint, we think that growth is going to slow. The economy was much more resilient than most had anticipated last year, primarily because of the consumer, but the consumer is really hitting a wall. You can see that through delinquencies from auto loans, credit cards rising. You can see that just simply by the ongoing reliance of credit cards at record high rates. This means to us the consumer is really just spending on fumes, and we expect them to pull back this year. That's going to weigh on economic growth, specifically in the first half of the year. From an equity perspective, finding the right price. We've seen specifically in the U.S. Growth, technology. We're looking at these areas of the market that are trading and exhibiting almost bubble-like characteristics. Be careful there. You're not being rewarded for that price you're paying at this time. The areas that we do want to look at, small and mid-cap stocks, they're cheaper, but not necessarily historically cheap. And we want to make sure that we're paying the right price that reflects the downside risk. Now, the one area that we're excited about in the global equity market is developed internationals. Now, that's an area that's so pessimistic that is reflecting in their valuations the downside risk from an economic standpoint. So we think that even the slightest upside surprise can result in quite a nice rally in developed international. Fixed income, get used to higher for longer. Get used to more volatility. When we talk about higher for longer, think about long-term interest rates. These are faced with the headwinds of ongoing treasury supply to fund our deficit, less demand for treasuries on the long end of the curve, and this back and forth between good and bad inflation data. And what does that mean for the Fed? So be careful of going out long, stay in that intermediate part of the curve, and look at municipal bonds as an alternative to not only treasuries, but credit, because you're being rewarded there. It's such a low credit risk environment. Alternatives. We continue to recommend alternatives specifically for qualified investors because it gives you another layer of diversification. But there's also great opportunity when there is a lot of volatility in the market. Look at things like private equity to diversify in your vintage year. Real assets. We have a tremendous amount of spending, not only from the government, but the private side on AI infrastructure. This administration is very supportive of that. Now, it's not just AI infrastructure that we need, but we also need infrastructure just to upgrade what we currently have. So these things in the real asset and infrastructure side of the market, these should be good long-term investors and also can hedge against inflation. Low volatility hedge funds are another way to hedge against the volatility in the public markets. Now, we'll continue. There's a lot of fluid things going on. We'll continue to look at our asset allocation. We're looking for opportunities to get into what we think might be a good opportunity in for global equities when we think the price is right. We invite you also, if you want more regular podcasts about what's going on in the economy and the markets, Markets with Megan offers a 2-minute podcast on a regular basis throughout the week to give you that insight. We also have 2 other really good podcasts from the ground up from our CEO, Leo Kelly. This is interviewing other business leaders and also how they've built their business and then business exit plans. Another podcast is The Alternate View, which is hosted by Matt Angelat, our head of due diligence and alternative investments. And this is a great way for you to get more knowledge about alternative investments and specific areas of the alternative market. If you have any questions at all, please feel free to reach out to your financial advisor.